Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Thursday, May 21st, 2020. I was considering putting out just a few static chart images for tonight's update, but I want to cover a few other charts and some things I haven't covered in a while, and it's better explained in the video format. So let's just jump into it. So what we had today is we do have breakdowns below these latest minor uptrend lines on the SPY. I'm referring to this uptrend line right here off the lows. We're on a 60-minute time frame, by the way. That's May 14th, so it's about a week ago. Had a minor uptrend line. We broke down. Not very impulsively, but about somewhat impulsively. You can see there's a 60-minute candle larger than the rest there, and a follow-through candle. And then what we did is we hit that 295 support. That 295 support, among other things, there's some other reactions there, but that's that significant high right here. That was that first test. Remember, that goes back to the 29th of April, the first time we hit the 200-day exponential moving average, and we've been trading around it, slightly above it. Kind of cleared it by a decent margin yesterday, now fell back to there. So we're right back again. Yes, same thing I've been saying for a while, right back to where we started, or really where we've been trading, or the top of the trading range now for months. But so as far as significant developments, this one started really no different than this breakdown here. This one also was not very impulsive at first, even less impulsive, but then there was follow through. And so what happened again? We hit, as you can see, we zoom in, these are 60-minute candles. A little momentum overshoot because there was a breakdown that brought in some selling, snapped the candle back to close right about on that 295 level and traded there all day. So that's it. It's kind of to be continued tomorrow kind of thing because the market broke down but hit support, traded there. There's some thin air below. It's not super thin, but I want to talk about that. When I say thin, I'm talking about support. You have a gap below, and it's a pretty sizable gap. Now, technically, the top of the gap is right here. I'm referring to this gap right here from the close on Friday, May 15th, to Monday's gap up right there. And as I said the other day, I do favor a backfill of those gaps. It'd be a pretty decent move down, and it might change some things on the more important daily time frame if we get it. So first things first, we've seen plenty of breakdowns, little minor trend line breaks that didn't go anywhere, but we've seen a few that did give you those 3% or more pullbacks. And again, based on what's building here, these divergences are building, and the charts are what I call stacked. You get sometimes what may be an innocuous little breakdown on a short-term 15-minute time frame, 60-minute, and depending on just how far it goes and how it looks, again, we have the potential to put in, some bearish developments, more bearish developments on the more significant daily time frames. And again, see how the week closes and especially the month. Today's the 21st. We've got about just over a week left in the month, and I'm very eager to see how the monthly candles close because that's either going to, well, we'll see. It could leave us, if we close right back on the long-term 20-month EMA, it'll just keep everybody guessing, at least from that one trend indicator. But if we close solidly above it or below it, that could change the technical outlook on that long-term time frame. So that's it. Here's what to watch for. I favor that because that is a breakdown because of the divergences and everything else. I favor that move down. Let's look at a couple other things. QQQ. The Qs, as I like to call them, same thing. We had a pretty clean trend line. It's the one we bounced off of the other day when the SPY had that whipsaw breakdown. QQQ bounced off support on Tuesday right here. That level went today, but the same thing. We had this is a reaction high, 229.42. I believe that level is on the chart, give or take, and we danced around it all day long. So just like SPY, we broke down below trendline support. It was somewhat impulsive. Again, no less impulsive than the initial breakdown back here. So that one, it didn't bring the heavy selling in right away, but once it became apparent to all that the Qs had broken that trendline support, boom, then the selling stepped in and continued, or really kicked in, I should say, and continued. And then, of course, same thing back here. A little breakdown, hit support, danced on support, back tested, and then, boom, big gap down. So, on gaps, you don't see a red candle, but that's effectively what that is if it was 24/7 trading like futures. But on QQQ, you have a lot of gaps because the futures do their thing overnight. So that's what we'll watch for tonight. If futures go up, then we held that support, and if they do, then what you want to look for is see what happens if and when we back test that trend line from above, and if we gap down, then again you have the top of the gap, you have that reaction low, and then you have this level here. Now let's talk about this and at 223 level. It's pretty darn significant. I think not only is it again that gap support right there on QQQ. But as I roll back, let me see, I think I have on a different board here. Yeah, here we go. 222.72 here, around 222.73. What it is, I'm going to turn this up. I use, you might notice these on my chart. Sometimes I have these tuned way down because I don't like a busy chart. A lot of trend lines, colors, it kind of takes away from the price action, but I've just turned up what's called the volume of price histogram. We can play around with the bars a little bit, but you can do it that way. And you can see that you have a big bar right here. You have a green and a red bar. And with a volume of price histogram, it's just as it sounds. It shows you the volume that has occurred at within a particular price range. So when I roll the scaling down here, it's just tightening up the range between here from 220 to 222, or I go here and it jumps from 220 to 225. So again, that's showing the volume that took place there. Either way you roll it, you've had those big the histograms, and these levels tend to act as support and resistance, and they're technically significant. Why? Because that's where a lot of buyers and sellers have met in here. Very few transacted here. Now the Qs have healthily popped above there, and it is an important level, and these levels act as support and resistance. So if we get a correction, where I'm going with this is that aligns with that pullback target. And again, I rolled back in time further here, and we can go even farther back. We can go quite a ways back. That I should have done that before. Actually, what I meant to do that before. I prepped this chart and showed you a lot of things have happened in there. I'm going to turn the volume up price down just a bit. I think you can still see it in the video. Sometimes I get complaints, or people telling me, hey, I can't see some of the levels on your charts. A lot of times it's just a monitor setting. These are recorded in high def, and if you're not seeing it, maybe you need to turn up the brightness on your monitor. Make sure the YouTube video is playing in 720p. I don't do the 1080. It just takes longer to upload. And looking at charts, there's no difference between 720p high definition and 1080. It's really not going to make a difference there on a video. That's why I do that. All right, so what you have is a reaction high and a gap right there, a big significant gap. That gap kind of started the party for the big drop down into the lows. That was after the market had topped. And it's kind of what I like to call the POR, point of recognition moment, where we had a big, powerful gap, one of the biggest in a long time, and it kind of just got the party started for the whole drop into the March lows right there. So technically significant for sure. Now the Qs are above it, so take it on face value. It's bullish that they're above that level, and again, that line that shows you the big volume of price histogram bars, and then the much smaller bars up there, says that's an important level. So it would be a very ideal target for a pullback. Now what that means, bullish if the Qs pull back and then bounce. If they don't even pull back and test it, well, obviously there's nothing much more bullish than that. But if they do, which I favor, look for a move there. If, however, they break it, the next big one is right here. You can see you have this cluster of 1, 2, 3 big volume price histogram bars, and then what I call a thin zone. You have a much smaller bar here, and that's technically significant. So let's watch that. If we go much below that 223 level, we move down here. Any move down below there, and a comparable level in SPY, I'm going to get that in a minute, would be probably start to bring in much faster selling. I think what will happen is I suspect we'll kind of work our way, grind our way back down there, because there's a lot of support in between here and here in that zone. We have a lot of gaps, a lot of reactions. It's that multi-month trading range. The Qs have more been in a upward multi-month trading range, where SPY, it's been more sideways. And remember, SPY is the stock market. This is just the tech-heavy fangs, everybody buying those mostly. Again, mostly what that is. So there's our kind of sideways trading range on QQQ. Again, levels to watch. And let me flip over to SPY, show you the same thing on SPY. Okay, so on SPY, which has been weaker, again, the stock market, the U.S. economy and all that is not QQQ. QQQ is not representative of that. SPY is. You can look at the Dow. DIA is the Dow ETF, and you can see the same story here. The Dow and the S&P 500 are really just slogging around sideways now for months, going nowhere. They refuse to go down. So yeah, if you are short or if you're expecting the market to ultimately run at those lows like I am, then it's, yeah, you can call it frustrating. But again, I've traded long enough, and you just have to recognize the trading range for what it is. And then, stay open. If the charts start to convince you, we start to do this, walk away from that range, and it's hard to chalk that up as anything but bullish. But until then, we bounce around at the levels where previous bear markets have stopped. 61.8% Fibonacci retracement, the 200-day moving averages, things like that. Then it is what it is. So here's SPY. Kind of grinding around sideways like the Dow, and you can see I have a comparable line. Let me tighten that up there a little bit. Here's the volume at histogram bars. So what I'm looking at here is a thin zone. That's where you have this big block of bars right here, and then a very, very big, you can see this bar only goes to right here, this one's shorter. So you have this thin zone right here above, and those thin zones often act as resistance. It works similar to a gap, and a gap is the ultimate thin zone. You can see we had a big gap right here, right, and reaction there. We traded quickly through there, and that's why you have a big thin zone here. So these are the levels I watched that are significant. So we have kind of banded, if you will, around this big cluster, and that's because that's where the majority of the trades over the past several months, before this whole, before the big drop or during the big drop, and then after, mostly after. This is where a lot of trades have occurred. Again, it's that trading range I've been highlighting. So where am I at? Well, one of two things will probably happen, is my guess. If we're going to have some type of fake out move, maybe a little blow off top, we can enter that, pop above, and we'll call that that should be right at about, let's make that a round number here for everybody, 299 on SPY. We can pop it and maybe to get into that thin zone. I doubt much above it. Who knows? There are more and more calls for new highs, which only makes sense logically. You're going to have, as the market goes up and gets closer to new highs, you're going to have more and more people calling for new highs, right? So I'm not going to knock those that are calling for that. Maybe they'll prove to be right, maybe not. We'll see. Only time will tell. There's that big gap below. So these are the key levels I'm watching, and kind of the takeaway from this is most likely scenario, at least my preferred scenario, kind of chop back down, work our way back down into there. Big thin zone there, quite bearish if we enter that. Support down there, and of course that would be the bearish scenario. Bullish scenario, my most bullish, but still a bearish scenario, is pop up there and do that. Now with today's breakdowns, I don't favor that, but watch it. If they foil today's breakdowns, or we only get those, let's say we come and backfill those gaps, or I'll get partially in those gaps and then head on up, that's it. What would that mean? Pop to come to the top of that thin zone. Let me give you the line right there, by the way. I should do that for you. That line's about 307.50 from 299 to 307.50. That would be, I should be able to do it quickly in my head, but I'll just do it here, about a little less than 3%. That would take us above the 200-day simple moving average. We're already flirting with the 200-day exponential, and that could be followed by a reversal then. And again, remember, it's this, and this across the board, these divergences, just like we had them here, just like you had divergence that were highlighted here, heading up to the highs. We had a few breakdowns before then. Here, let's look at one of those charts. Let's go to this board here. Yeah, we can do that. I don't have. I had different boards, and some of them were marked up, but I've already gone over that. We had the same type of divergences leading up to the drop, the highs back in February, and we even had a breakdown like this, and then a little kickback rally, especially on the Qs, just like QQQ. We broke down the primary trend line there, and QQQ. Here, I'll show you. Here's the Qs. We had a breakdown, kind of pushed up, continued to diverge, right? This is today. Here's what we're looking at. And then if we go back in time, let's do it here, and let's zoom in like this for you. This is what it looked like back then. You had divergence, you had a breakdown. Here's it's not exactly the same, but you can see we had a divergence, little sell signal there. Market went sideways for a while, so we had negative divergence at that point, but it didn't play out for much. It extended, continued to extend, and finally it did play out. It played out for the big one. And so again, that's what we're looking at here. So, sometimes these divergences take a while to play out. When the bigger they get, typically the bigger the drop. And then once in a while, like I said, hard to put an exact number, but I'm usually saying around 10-15% of the time, probably even less than 50. I'd say 10 at best. The divergences just get burned through, and they never really materialize for a trend reversal. But unless they're still there, it's the divergences coupled with the fact where the stock market is at, and I'm talking just pure technicals. Don't even get me started again on the fundamentals. That is, like I said, and some others have said, it's just, it's almost insane that, with what's going on. I think I just heard on NPR today, they expected the projections for the drop in GDP in the second quarter, second quarter, is expected to drop, I think, 28%, 28% drop in GDP, and the stock market, or at least QQQ, is trying to power up towards all-time highs. Is just insane, in my opinion, and I think anybody else that uses fundamental analysis. But price, sometimes the market will shrug off fundamentals, and there's been times where it's been a lot more overvalued than this. This one's just kind of a little bit perplexing, and again, we all know that a good part of this, and possibly 110%, 120% of this, is due to what the Fed is doing. The Fed is what they're doing now is unprecedented. It dwarfs what they did in 2008, and back then that was unprecedented. I'm talking about the amount of money and the steps they're taking to shore up, prop up the stock market and the bond market, which is probably much more important of the two. The fact that they're backstopping the credit markets undoubtedly is give fuel to the stock market rally. But with that being said, I'm a firm believer that they're not omnipotent, and they cannot invariably lift the market. That ultimately the stock market is a huge giant machine, the global economy, global stock market, and ultimately it will go to where the fundamentals indicate that it should go. This is just short-term noise. Okay, quick look at the futures. No reason to spend too much time, but I do know a lot of traders like to trade the futures, and I like to watch them as well. So we have pretty much divergent 1, 2, 3. That's slightly lower than, for all intents and purposes, that's about an equal high while we continue to diverge. So there's a negative divergence. We're starting to roll over. Maybe come in, back test this trend line again. That's ES, I should have made clear. And then next to that we have NQ. We should look at NQ as well. Let's get it somewhere over here. There we go. NQ, NASDAQ 100 futures, trend line breakdown, back test. We danced on that 94.15 support for a little while, and then made the back test and now broke that. That opens a door down here. We're clearly below support. Those are plenty of 60-minute candles. That should open the door for a move down. Probably happen tonight, is my guess, down to at least 93.01, and possibly more. These are all potential targets. So let's just right now kind of eyeing that 91.11-ish target. I think that's let's see if that meshes with the gap backfill in QQQ. That would be a 2 point in the futures, about a 2 point from where we are, 2.7% or so drop, and on the Qs, should the Qs go on to backfill the gap, that would be a drop of, it's a little bit above 223. That'd be 2.35. Yeah, close enough. So those are levels to look for or watch for, and those are my near-term targets right now. And finally, XLK. When tech breaks, the market breaks. Tech has broken down. We're coming up on support, a big, pretty decent, not huge, but a decent. That's the top of the gap at 95. I need to give you another line here, and the bottom of the gap is right there, so 93.46. So if I'm looking for a gap backfill on the Qs, I'm obviously looking for a gap backfill on XLK. And remember too that QQQ could, or SPY might hit the backfill the gap first. If we go down from here, of course, I'm making those assumptions. You want to watch them both, because what'll happen is the buyers may step in when SPY, if and when SPY hits the backfills that gap, or they may step in if and when QQQ if they don't hit them around the same time. So you want to watch for that. And then XLK, same thing. XLK is going to almost mirror QQQ, and that's about 2.86% or so drop there, and that's it. So little story is a little divergent high here. We had a minor trend line break right there. You can see two little comparable red candles, 1, 2 right here, just like these two, right? Then boom, they started selling it. And like I said, when tech breaks, the market breaks. We zoom back to what happened in February. Well, we had a market that, just like now, felt like it would never go down, felt like the fangs were going to go to the moon and beyond, that they were unbreakable. And we had a little 60-minute wedge here in XLK. It broke down, little back test. Started moving lower, and that was it. So some of these breakdowns and some of these divergent highs just result in minor corrections. But when you have these persistent divergences, they usually do end up playing out, and usually the more persistent they get or longer they extend, the bigger the drop. So that's what I'm looking at. Just want to point out techs, and I'm going to use this stocks trade. This was a recently stopped out trade. You win some, you lose some. We had plenty of successful trades on stocks and plenty of unsuccessful trades, like anything else. But the technical case, we shorted it last time somewhere here after that last divergent high. We had what appeared to be at the time, to me, an objective entry, a breakdown of a uptrend line right here. We had divergence building, and we started to get a correction that was foiled. We went on to basically we went above our stop, 2470. If it's still listed, always look at the notes on the trade. I'm just sloppy on getting behind. I've been falling behind and finding the time to update these trades and post, hey, here's the exact loss. I try to always post a final update if a final price target is hit and or the stop. Well, each time a target is hit, I'll post an update. Sometimes not right away. There's some trades that have hit price targets I haven't even updated yet officially. I cover these in the videos. So this one was stopped out when he closed above 240.70, but we've made a marginal new high. So they ran the stop, and we're right back, almost back to where the stop was. But look, what's happened here? Technically, nothing has changed, at least not with these divergences. This is DH3, divergent high 3, meaning it's not a separate divergent high. It's simply this was where DH2 was, right here, and we extend these divergence lines out, and it just sets the stage for an even bigger drop. Just like this was a divergent high, little correction. The divergence extended. They extended here on the RSI, not so much on the PPO actually. We did have a little divergence right here, but then a big drop. But right now it's clear. 1, 2, 3, three divergent highs, or actually one divergence, if you will, with little corrections after each one. And so that sets the stage for what I believe to be at least a move back down to my first target from before. If any of you are still in that or looking for a trade idea, I noticed some weakness in some of the semis today, and some technically significant weakness is one thing. The market's been powering up, kind of grinding higher, especially tech. So here's one, and again, I'm picking on former trades that were stopped out because they're stocks that stay on my radar. This one was stopped out back here on a daily close above 303.50 a while ago. I haven't updated since then, but I've been watching it, and this is NVIDIA. And you can see now we have very extreme overbought conditions. Last time we were this overbought, right here, at such levels was all the way back here. Overbought is not a sell signal because you can get and stay overbought for a while, but it then usually manifests in the form of a correction. And this time around, that was a big drop in NVIDIA. Again, we were more overbought here recently than we were here. So this was the comparable overbought reading. You can see what happened. And technically, what we have here are a couple things to watch for tomorrow. Should the futures go down tonight, or whatever reason, let's say the futures do what they want to do, doesn't matter. Let's just look at NVIDIA in a vacuum. What we have here is the potential for an island cluster top. It's just the potential. An island cluster top is when you have a cluster of candles like this separated on both sides by a gap. So right now we have that cluster separated by a gap on this side right here. So an island cluster top, one of my favorite patterns. is you get a gap down. So should we gap down tomorrow or anytime soon? Maybe the island continues for tomorrow or a couple days, and then we gap down. They're great patterns because they offer tremendous risk reward. First of all, they're pretty high probability if you get it, and second of all, they offer a very attractive risk reward. So if you get a gap down, you go ahead and short it, and then it depends on how you want to trade it. What I like to do is give it a little room, only because in the old days I used to say, well, here's it. If you gap down, you have, let's say there's your island. So if you gap down here, put a stop just above the bottom of the island right there, right? And there's a very low, maybe it depends on how much that is, 1, 2, 3%, depends how far NVIDIA gaps down. That's your loss potential. But the thing is, these are, if stopped out, your loss potential. But these are topping patterns, not just pullback patterns. They can put in a major top, and they often do. So your downside potential is huge. So you might risk 3% to make 20, 30% or more. It all depends, on where NVIDIA goes. So something to watch out for there. Now, what I was going to say is the algos know, over the last, last couple decades since I've been doing this, more and more I see stop rates, more of the trades that I've had, more places I used to strategically and tactically set a stop a little bit above where, the pattern would be foiled. But the algos then know that's where everyone sets it. So I tend to give it a little more room. I'm learning to use wider stops, even if it means a less favorable risk-reward ratio than I used to use. Sometimes I'll go down to a 2-to-1 RR instead of a 3-to-1 minimum risk-reward ratio, and I'm finding that it keeps me in trades a little bit longer. SPY, we'd still be in that if I gave it a little more room, but I told you SPY, I wasn't here yesterday to pull the stop, nor would I if I was at my desk, because that one was just getting more of a nuisance trade, constant updates, a constant revision to the stops. However, on NVIDIA, back to what I wanted to talk about here, we have not only that, so you have a minor trend line, you have a gap right there with the potential for an island top, again, just potential, and probably a lot of thin air below. And on the more significant daily chart, we have a nice bearish engulfing candle today. And we had a couple doji candles that it follows as well. So that's a little bit more significant. Dojis are, they call those indecision candlesticks. It's when the stock opens up and, opens up, has a trading range, that skinny part, the shadow is where it traded throughout the day, and then the stock ends up closing about where it opened. That's why you have the small body. In this case, same thing. You opened up down here, went up intraday, but then ended up closing back down where we were. So 3 dojis right there. Now, you might have heard recently I talked about the indexes. We had some bearish engulfing candles, and it didn't play out. As I said, they don't always play out. They're pretty reliable, but they're not 100%. If there's any indicator that's 100% in trading, it wouldn't be for long because everyone would know it and they'd jump on it. So, the day I stopped recognizing things like bullish and bearish engulfing candlesticks, it basically means I've given up on technical analysis. So there it is. It's a bearish engulfing. What do you want to see when you get a bearish engulfing? Number one, I want to see follow through. That means another red candle tomorrow, red close tomorrow. Like I like to say, the redder the better. Especially if we can gap down below, give us that. This would be the same thing on the daily chart I just showed you. An island cluster right here. There's your cluster of candles. And so should NVIDIA gap down tomorrow and close, leave a gap there, then you have a confirmed sell signal via an island cluster top. Maybe I'll add it as another official trade. If I don't, you have the same targets as before. Only thing I would add, I would say that stop, right about that stop. You can see what they did to our stop. They popped it wherever they got it here, came in, and it's since developed to be, maybe I had it there before because it was resistance, but you can see when they broke above 303.50 back here, right here, they came in and back tested it. So you had the breakout. You already had a reaction right there, and then you back tested it. It gave us another reaction, and that validates that as a significant support level now. So that would be first and minimum target. And what would that be from where we closed today? Roughly a drop of about 13%. So you get a lot more bang for your buck on individual stocks than you do on the market too. So that's also another thing. I might go back. Believe me, there'll be other trades on the broad market, IWM, QQQ, SPY, things like that. But it's these individual stocks that give you more bang for your buck, like Netflix. Down more than the overall market today. The potential I just showed you in the video, and maybe a little bear flag pattern in Netflix. We'll see what happens tomorrow. What I'm referring to is if the futures drop tonight, or even hold up tonight, and then we open around flat at tomorrow morning, or at least Netflix does, and then moves down. Either way, whether you gap or not, what you want to see now, since you have this bear flagging type pattern action, you want to see an impulsive move down, whether you gap down or open tomorrow and head down there, and that would take us to that first target there we have about. That would be about the measured target too for the bear flag pattern. So that's it. Let's wrap it up here. Those are some of the things I'm watching, and again, charts are indicating right now good chance for a correction. And you can see as I turn the volume up, price histogram bars up as well on Netflix. See this void right here? That's that thin zone. And see where T2 is set a little bit above that. You have this big thin, really thin bar right there, small bar, and then this one here, and then it kind of comes out there. So there's a potential for additional targets. But if Netflix, and that's why T1 is right there at 419.85, that's the top of that zone. So that should be, and I would expect a reaction. That's why I have multiple targets too. The way I think this one will play out is impulsive leg down tomorrow. Probably hit that first target tomorrow is my guess, or no later than no later than Monday if we don't get it tomorrow. Tomorrow's Friday. Probably get a reaction there and a bounce. If you're not an active trader, then I think it makes sense to hold out for that. I wouldn't put T2 as a final target if I didn't think the trade had a good chance of hitting it. But if you just want a quick win under your belt, if you get to T1 or you're an active trader, you can book profits, game the bounce, and if you want, you can jump back in after that level goes. Remember, the price targets, the official targets, are set above the actual support level. Supports. Actually, I set that one tight because I think there's a good chance we'll hit it. I only set that a penny above the actual support level because I actually think the reaction will come a little below there, around 413.09 is a possible level there. I had in kind of my mind's eye more of a support zone here on Netflix where it may reverse, and that's why I set the first target there. All right, we'll wrap it up here and see. We'll pick it up tomorrow. See what the futures do tonight, and if they kind of hold up flat, we'll watch the open tomorrow and see how things start trading in the morning. This has been Randy Finney with Right Side of the Chart. Have a great evening.